Imagine you found the perfect house. 3 bedrooms, good neighborhood, decent backyard. The asking price is $400,000. You run the numbers, you can make it work. Then your lender calls. The rate changed overnight. Not by a little, by enough to add $400 to your monthly payment. Same house, same price, same you, just a different number on a screen somewhere in Washington, D.C., and suddenly, the dream doesn't fit anymore. This is happening to real people, right now, not in some abstract economic textbook, not as a warning about what might happen someday. It's happening in living rooms and kitchen tables across America, and most people have absolutely no idea why. So let's talk about it, not the version your bank explains in a pamphlet, the real version, the one with teeth. Here's the uncomfortable truth that most finance content glosses over. Mortgage rates don't go up because your bank decided to be greedy. They don't go up because the housing market is hot. They go up because of a chain of decisions, some made decades ago, some made last Tuesday, that connects your monthly payment to things like government debt auctions, global inflation fears, and the career ambitions of a handful of economists sitting in a marble building in Washington, D.C. And once you understand that chain, you can never look at a mortgage rate the same way again. Let's start from the beginning, not the boring beginning, the one that actually explains what's happening. When you borrow money to buy a house, someone has to actually provide that money. You probably assume it's your bank, and technically, yes, your bank writes the check. But here's what most people don't realize. Within weeks of giving you that loan, your bank sells it. They package it up with hundreds of other mortgages, wrap it into something called a mortgage-backed security, and sell it to investors, pension funds, insurance companies, foreign governments. Massive pools of capital that are always looking for a safe, steady return. This system has a name. It's called the secondary mortgage market, and it is enormous. We're talking about a market worth over $12 trillion. That's not a typo. $12 trillion. The rate you get on your mortgage is essentially the rate that investors in this market are willing to accept in exchange for buying your loan. If investors want higher returns because they're nervous, because other investments look more attractive, because they think inflation is going to eat into their profits, the rate goes up. Your bank isn't setting your mortgage rate in a vacuum. It's reading the room. It's asking, what are investors demanding right now? And then it adds a small margin on top of that, and that number becomes the rate on your closing documents. So the question isn't really, why is my bank charging me more? The real question is, why are investors demanding higher returns on American mortgage debt right now? And to answer that, you have to understand what investors are actually afraid of. The single biggest driver of mortgage rates in this country is the yield on the 10-year U.S. Treasury bond. If you've never paid attention to this number before, start paying attention now, because it is the heartbeat of the American financial system. Here's how it works. When the U.S. government needs money, and it almost always needs money, it borrows by selling bonds. A 10-year Treasury bond is basically the government saying, lend us money today, we'll pay you back in 10 years with interest. The rate on that bond, the yield, is set by the market. If lots of investors want to buy treasuries, yields go down. If investors are nervous about lending to the government, or if they think they can get better returns elsewhere, yields go up. Now, why does this matter for your mortgage? Because both instruments, treasury bonds and mortgage-backed securities, are competing for the same pool of investor money, and investors are always comparing them. Treasury bonds are considered the safest investment on earth. The U.S. government has never defaulted. So when an investor is deciding whether to buy a treasury bond or a mortgage-backed security, they need to be compensated for the extra risk of buying the mortgage. That extra compensation is called the spread. Historically, 30-year fixed mortgage rates run about 1.5 to 2 percentage points above the 10-year Treasury yield. So if the 10-year yield is 4.5%, you'd expect mortgage rates somewhere around 6 to 6.5%. Watch the 10-year yield. It tells you almost everything you need to know about where mortgage rates are heading. So what moves the 10-year yield? This is where it gets interesting. And by interesting, I mean slightly terrifying. The 10-year yield is driven by two things that are constantly wrestling each other: inflation expectations and Federal Reserve policy. Let's talk about inflation first, because this is the one that hits closest to home. When inflation is high, when prices across the economy are rising fast, investors start demanding higher yields on their bonds. Why? Because if they lend money today and get paid back in 10 years, they want to make sure the money they get back is actually worth something. Inflation erodes the purchasing power of future dollars, so the higher the expected inflation, the higher the yield investors demand to protect themselves. Think about it this way. If you lend someone $1,000 and they pay you back in 10 years, but a bag of groceries that cost $100 today costs $180 by then, your $1,000 doesn't stretch as far as it used to. You've technically gotten your money back, but you've lost purchasing power. Investors aren't stupid. They price that risk in. So when inflation surged, and if you were alive from 2021 to 2023, you felt it. Treasury yields climbed, and mortgage rates climbed with them. In early 2021, the average 30-year fixed mortgage rate was sitting around 2.65%. That was historically low, historically extraordinary, actually. By October of 2023, that same rate had climbed to just over 8%. That is the largest and fastest increase in mortgage rates in modern American history. People who bought houses in 2021 locked in at 2.65% and thought they were geniuses. People trying to buy in 2023 were looking at payments that were, in some cases, literally double what they would have been 2 years earlier. Same houses, double the cost of borrowing. That's not bad luck. That's inflation doing exactly what it always does. Now let's bring in the other actor in this story, the Federal Reserve. The Fed is probably the most powerful financial institution on Earth. It sets the federal funds rate, the rate at which banks lend money to each other overnight, and that rate influences the cost of almost every other form of borrowing in the economy. But here's the thing people get confused about. The Fed doesn't directly set mortgage rates. That's a common misunderstanding. The Fed controls short-term rates. Mortgage rates are driven by long-term bond markets. The connection is more indirect and more complicated. When the Fed raises rates, it's trying to slow down the economy. Higher short-term borrowing costs mean businesses borrow less, people put less on credit cards, economic activity cools, and when economic activity cools, inflation is supposed to come down. If inflation comes down, long-term bond investors get more comfortable, yields on the 10-year Treasury fall, and mortgage rates follow them down. That's the theory. In practice, it's messier. Between March 2022 and July 2023, the Federal Reserve raised its benchmark rate 11 times. 11. They went from near zero, the emergency pandemic level, to over 5%. It was the most aggressive rate hiking campaign the Fed had launched in 40 years. And it worked. Sort of. Inflation did come down. From a peak of around 9.1% in June 2022, it fell back toward the 3% range by mid-2023. Progress, real progress, but not all the way back to the Fed's 2% target. And this is the trap the entire housing market fell into. Investors looked at the data and said inflation isn't fully defeated yet. The Fed might have to keep rates higher for longer, or raise them again. That uncertainty pushed long-term yields up, which kept mortgage rates elevated. Even as the Fed paused or hinted at cuts, the bond market wasn't entirely buying it. The result? A housing market in a kind of suspended animation. Rates too high for most buyers, sellers unwilling to give up the low-rate mortgages they already had, inventory frozen, prices stubbornly high despite unaffordable financing. It was a paradox nobody planned for and almost nobody predicted with any precision. Let me show you the math, because this is where most people stop doing the arithmetic and just feel vaguely stressed. Let's say you're buying a $450,000 home. You put 20% down. That means you're financing $360,000. At a 3% interest rate, which felt normal not long ago, your monthly principal and interest payment is about $1,518. At 7%, which has been the rough range for much of 2024 and into 2025, that same loan costs you $2,395 per month. That's $877 more every single month for the exact same house. Over the life of a 30-year mortgage, at 3%, you pay about $186,500 in interest. At 7%, you pay approximately $502,000 in interest. You read that right. On a $360,000 loan, the difference between a 3% rate and a 7% rate is roughly $315,000 in additional interest paid over time. Buying the same house costs you $315,000 more, not because the house got more expensive, because the rate changed. Now do you understand why people are frozen? Why existing homeowners refuse to sell? Why first-time homebuyers are living with their parents longer than any generation in recent memory? This is the mechanism. This is the hidden tax that nobody voted for. Let's talk about something that doesn't get nearly enough attention, the lock-in effect. In 2020 and 2021, tens of millions of American homeowners refinanced their mortgages at historic lows. We're talking about rates between 2.5 and 3.5%. Millions of people locked in those rates for 30 years. Now, with rates at 7%, those same people are essentially trapped in their homes. Not because they hate where they live, but because selling means giving up a 3% rate and taking on a 7% rate on their next purchase. Let's say you have a $300,000 mortgage at 3%. Your payment is around $1,265 a month. If you sell your home, buy something else, and have to finance $300,000 again at 7%, your payment jumps to $1,996. You'd be paying $731 more every month just to move. So people aren't moving. Inventory has collapsed, and because inventory is low, home prices have stayed stubbornly elevated, even though rates have made buying nearly unaffordable for most people. It's a bizarre standoff. Buyers can't afford to buy, sellers can't afford to sell, and the housing market, which is supposed to be a dynamic system, has essentially seized up. This wasn't inevitable. It was a predictable consequence of the rate environment, but almost nobody in a position of authority was modeling this scenario in 2020 when rates were pushed to zero.
Now let's zoom out even further, because there's a bigger force at work here that most people aren't talking about. The U.S. government has a spending problem. This isn't a political statement, it's arithmetic. The federal deficit has been running at over $1 trillion a year for years. The total national debt recently crossed $34 trillion. To fund that deficit, the Treasury has to keep issuing new bonds. Lots of them, more than ever before. And here's the problem. When you flood the market with new bonds, basic supply and demand says yields go up. More supply, same demand, prices fall, yields rise. There's also a subtler version of this problem. For decades, two of the biggest buyers of U.S. Treasuries were foreign central banks, particularly China and Japan, and the Federal Reserve itself. These buyers absorbed enormous amounts of supply and kept yields artificially low. China has been gradually reducing its treasury holdings. Japan, facing its own currency pressures, has been doing the same. And the Federal Reserve, which during the pandemic bought trillions of dollars of treasuries and mortgage-backed securities in a program called quantitative easing, is now doing the reverse. It's letting bonds mature without reinvesting, shrinking its balance sheet. That program is called quantitative tightening, and it removes a massive buyer from the market, which means other investors, private funds, foreign governments, regular institutions have to absorb more supply, and they want to be compensated for it. More supply, fewer traditional buyers. That's a recipe for higher yields, and higher yields mean higher mortgage rates. This isn't a temporary condition. This is a structural shift in how the U.S. finances its debt, and it will have consequences in the housing market for years, possibly decades.
Let me introduce one more concept that is quietly reshaping everything: the term premium. Stay with me here, because this one actually matters enormously, and almost nobody explains it simply. When investors buy a long-term bond, a 10-year or 30-year treasury, they're taking on more risk than if they bought a short-term bond. Not credit risk, duration risk, the risk that over the next decade something changes. Inflation comes back, the political situation deteriorates, the dollar weakens, any number of things. For a long time, especially from 2010 to 2021, investors accepted very little extra compensation for that risk. The term premium was near zero, sometimes negative. Investors were essentially saying, we're so confident in the stability of the future that we don't need to be paid extra to take on 10 years of uncertainty. That era is over. Investors are now demanding more compensation for duration risk. The term premium has risen, and every time it rises, long-term yields go up and mortgage rates follow. The age of near-zero rates wasn't just a policy decision. It was a specific historical moment driven by post-financial crisis fear, pandemic emergency spending, and global excess savings. That moment is gone. And the adjustment to a new normal is exactly what you're feeling every time you look at mortgage rates today. So where does this leave us? Let's be honest about the forecasting problem. Every major institution, the Fed, the IMF, Wall Street banks, the mortgage industry itself, has been consistently wrong about where rates are going. In late 2022, many predicted mortgage rates would fall sharply through 2023. They didn't. In 2023, the consensus expected meaningful rate cuts in early 2024. They came late and they were modest. The bond market keeps surprising the experts. Here's why. Predicting rates requires predicting inflation, which requires predicting geopolitical stability, supply chain behavior, consumer psychology, energy prices, and about 50 other variables that are genuinely unknowable with precision. Anyone who tells you they know exactly where 30-year mortgage rates will be in 18 months is either selling something or deluded. What we can say with confidence is this: the era of 3% mortgages was an anomaly, not the norm. The historical average for the 30-year fixed rate, going all the way back to the 1970s, is somewhere around 7.7%. By that measure, where we are today isn't a crisis, it's a return to historical reality. But that historical reality collides head-on with home prices that got inflated during a period of historically low rates. The combination, high prices and high rates, is genuinely unprecedented. Affordability, by almost every metric tracked by housing economists, is at its worst level in decades. And this creates a question that nobody in power seems to have a clean answer to. If rates stay high, housing affordability continues to deteriorate. A generation of younger Americans gets priced out of homeownership. Wealth inequality, which in America runs directly through homeownership, deepens. If rates fall sharply, the locked-up inventory floods back onto the market. But so does renewed buyer demand. What happens to prices then? They might rise again, even with higher rates, and a new round of refinancing activity could overheat the economy and bring inflation back. It's a trap, and the people sitting inside it, the first-time buyers, the young families, the people who played by the rules and saved up a down payment, didn't build it. They just have to live in it. There's a dark irony sitting at the center of all of this. The Federal Reserve raised rates to cool inflation and make life more affordable for ordinary Americans. But in the housing market, which represents the single largest purchase most Americans will ever make, higher rates have made things dramatically less affordable. The medicine made the patient sicker, at least in this one corner of the economy. And the people least able to absorb higher costs are exactly the people most exposed to them. First-time buyers who can't fall back on home equity. Renters who are seeing their landlords pass cost increases straight through to monthly rent. Young people who did everything right financially and still can't get their foot in the door of ownership. Meanwhile, people who already own, especially those who locked in low rates, have seen their home values stay elevated and their mortgage payments stay fixed. The same interest rate environment that's crushing buyers is protecting existing owners. This is not some villain's plan. Nobody orchestrated this deliberately. But systems don't have to be malicious to be unfair. They just have to be complex enough that the unintended consequences fall unevenly. And in America right now, the unintended consequences of a decade of cheap money, followed by the fastest rate hiking cycle in 40 years, are falling very unevenly indeed. Here's the final thing I want to leave you with. Mortgage rates are not a natural phenomenon. They're not like weather. They're the output of a system of policy decisions, market incentives, investor psychology, government fiscal choices, and global capital flows. Every part of that system was built by human beings, making decisions with imperfect information, which means it can be different, which also means there are people who benefit from it being exactly the way it is. When you hear politicians talk about housing affordability, listen for what they're not saying. Are they addressing the structural supply shortage that's kept prices high? Are they willing to have a real conversation about government borrowing and its effect on bond yields? Are they talking honestly about the relationship between monetary policy and the cost of homeownership? Usually they're not, because those conversations are complicated, unpopular, and don't fit on a campaign sign. So instead, mortgage rates stay high. Builders struggle to make entry-level housing pencil out financially. Young families double up or rent indefinitely, and the gap between those who own and those who don't gets a little wider every quarter. The question isn't just why mortgage rates are going up. The question is, who does that serve, and for how long are the people it doesn't serve willing to accept the answer? That's not a comfortable resolution, but it's the right question to be sitting with. Because understanding the system, really understanding it, is the first step to demanding something better from it.